Good day, everybody. It's Greg Schnell, and I am here with Martin Pring to do the market roundup for the end of December 2019, the end of the month, the end of the year, the end of the decade. Martin, how are you doing?
I'm doing great, thanks, Greg. How are you?
Hey, very good, Martin. I am sitting up in the Rocky Mountains in Canada. You're down in sunny Florida, so we're a long way apart, just about corner to corner on the continent. But I think our charts look the same. Lots of bullish messages out there.
Or bearish ones, depending on what you're looking at.
Yeah, that's true. A few bearish ones starting to show up for me in the bond side, but I'm very interested to see what you've got. I know all of my breadth indicators and everything are still very bullish. Are you finding the same thing?
Yeah, yeah.
Yeah, it's looking pretty strong out there. So anyway, I'm interested to see what you got. How about showing us some of those charts?
Okay. Well, let's just take a quick summary of what we're going to cover today. First of all, we see some tentative signs that the slowdown is ending, and that should be bullish for stocks and also bullish for commodities and bullish for interest rates. The stock market is only just beginning to get bullish, in my view, in terms of some of these longer term indicators. They're around just below zero and they're starting to turn up, or they're around zero and starting to turn up. Nowhere near getting into an overstretched condition on the upside, even though we've had a good rally at this point. I'm notwithstanding, of course, the odd sharp shakeout or a short-term correction. We always get those. But the long-term primary trend still looks to be in its early stage of being positive. And in the last month, it's only just happened that some of the rest of the world has started to perk up as well. So things, I think, going into the next decade look pretty good. So what we're doing now is, as we mentioned last month, is getting ready to look for a bottom in commodity prices, which may already have actually taken place. But I think there's a pretty good chance that we're going to see a good rally, and I'll explain why as we go through. And when commodity prices rally, typically you'll find the dollar is declining. That's not always the case, but it's the case the majority of the time. They move in opposite directions. And the dollar does in the last couple of weeks or so appear to have started to break down. So we'll take a look at the dollar right at the end of the presentation. But right now, I'd like to go through a diagram which I went through last month that we use as a kind of a basis for our strategy at Pring Capital Group. And also I use it in my monthly Intermarket newsletter pretty consistently, because to me, this is the framework, kind of map, if you will, of how the economy works and how it integrates with the various markets, and why you can see sometimes all the markets go up and other times they're all coming down, other times they're kind of mixed. So the idea is we've got this growth path of the economy here. When we're above the blue line, we're in a growth path. When we're below it, we're in a contractionary phase. And at the beginning of the cycle, what happens is the Federal Reserve starts to throw some money into the system. And at the same time, that's on the supply side, and on the demand side for credit, the demand goes down because the economy is weakening. So anytime you get supply increasing and demand contracting, the price comes down. And the price of credit, of course, is interest rates. And when interest rates peak, bond prices bottom out. So now we have falling interest rates going into the real depth of the recession. And at some point, the people in the stock market begin to anticipate the next recovery that's going to take place. So instead of waiting for that recovery, they actually buy literally when the news is blackest and when the rate of change of the economy is actually at its lowest point, the coincident measures of the economy. So the next thing to look for is the bottom in commodity prices, and that takes place as we start to move into the early recovery phase. And then the economy picks up, the Fed becomes less accommodative, and credit demands begin to pick up because the economy is picking up. So the price of credit also starts to pick up, which is interest rates. When interest rates bottom out, bond prices peak. But at this point here, interest rates are going up, the profits are going up faster. So the stock market continues to move up until it meets basically its maximum momentum on the upside. When it gets to that point, the players in the stock market begin to anticipate the next recession, just as they had anticipated the next recovery on the left-hand part of the diagram. And then finally, of course, we get commodity prices peak out somewhere around this point here in the cycle. In our work, we use barometers or models for bond, stocks, and commodities, and they help us determine which cycle we're at. So in other words, if all three of them are bullish, that would put us at this point here where commodity prices bottom. If only bonds and stocks are bullish and commodities are bearish, which is currently the situation, that puts us at that point in the cycle. And that's where we think we are right now, is in this stage here when bonds are going up, stocks are going up, and we're waiting for the low in commodities. Although we think actually that commodity prices probably bottom at this point here, but we need more evidence, more long-term moving average crossovers, and so forth. So we think we're about at this point here at the end of the green shading, and you may be saying to yourself, well, if that's the case, how come we haven't had a recession? We should be coming out of recession from what he's telling me. Well, sometimes what happens, instead of going below that blue line, the growth path of the economy comes down to it and then has a soft landing and then takes off, rather like this diagram here. And that slowdown is called a growth recession or a growth slowdown. And we still get the cycle repeating with the chronological sequence of the markets, but they're less volatile and it's much more spread out. So in other words, in a bear market for stocks, in a recession, you're going to see a much larger decline take place than you will see in a slowdown. So the slowdown is a kind of like a pit stop on the way to further prosperity. And it avoids going through a recessionary period, so it's kind of a cathartic experience that takes place. Also, the slowdowns are separated by something like a 41-month from trough to trough, 42 months. If you take it since the 1960s, there have been 17 actual economic events, in other words, recessions and slowdowns, and they've averaged between trough to trough around 42 months, which is very similar to the 41-month cycle discovered by Joseph Kitchens in the 1920s. So anyway, we figure we're around this point here where my cursor is now, where the growth path has come down, and it's now beginning to very slightly pick up to the upside. So that puts us in a very delicate situation, because we get some really unexpected bad news, like say the removal of Trump or something like that, as opposed to impeachment. That could very well affect the psychology of market participants and push the economy to a downward movement. But most of the indicators, the long leading indicators that I'm looking at, are starting to point to the upside in terms of a soft landing. So that's what we have to go with, is the evidence we have at the present time. And it looks like we're going to get a third recovery in this overall recovery since 2009. So as I said, the growth slowdowns are a cathartic experience as the economy pauses to refresh. It's associated with a 10 to 15% decline in the stock market, each of these slowdowns. And that's something, that's what we saw last December when the market went down. I think it was 10 or 12% into December of last year. So we've already gone through that process. And also these slowdowns explain how you can get these secular bull markets and equities, where the bear markets are kind of mini bear markets like we've seen since 2018, between 2018 and the beginning of 2018 and the end of 2018. So here's a nice leading indicator that I've followed for years. It's called the ECRI Weekly Long Leading Indicator. And if you Google their site, you can update this. You can go back and get the past data and update the data each week, which I thoroughly recommend. The red highlights here represent recessions, and the vertical lines represent the long-term KST buy signals for the ECRI. And as you can see, if you look to the right of these green vertical lines, you'll see that the economy, as monitored by the ECRI weekly leading indicator, started to move up. So what we're seeing, you can sort of clearly see these previous slowdowns we had, the one in 2011, 2012, one in 2014 to 2016, and one since 2018. And that appears to be starting to turn out from around a zero level, kind of almost a perfect rendition of that diagram that I showed you in the previous slide. When you look at the, and you can also see that most of these KST reversals, excuse me, to the upside have been followed by a nice recovery in the ECRI. Right now, what we're seeing is the ECRI weekly indicator is broken above this trading range. And to me, that in combination with the KST turning up is pretty strong evidence that we're going to get a more durable rally going in the economy. You can see in this trading range environment here very, very easily how we have been in a slowdown period and now beginning to emerge from it. So if we're looking at a point where we're looking for the bottom in commodities, or a bottom in commodities, or an early rally in the bull market in terms of commodity prices, we'd expect to see a bit of if a change is taking place between the balance of these financial markets, we'd expect to see that reflected in the sector work. And what we would expect to see will be early cycle leaders start to lose some relative strength, and late cycle leaders, earnings-driven things like resource-based and materials and so forth, start to improve. So this chart here shows a typical REIT. This is the ICF, the Cohen & Steers REIT. Underneath in these panels, the bottom two panels, is the relative strength against the S&P. And you can see that up to around October or November, this REIT, like pretty well all REITs, have been improving in terms of relative strength. And the KST for relative action started to improve. But now what you're seeing is you break the uptrend line, you cross below the 65-week exponential moving average, and the KST starts to turn down. So that's typically what action that we're seeing in a lot of the leading sectors, leading ETF sectors. So if we move on and look at something from the opposite sphere, the late cycle leaders, this is the silver miners. And you can see we get a slightly different picture here because they're breaking out on an absolute basis and the absolute KST is turning up. When it comes to relative action, that's also starting to turn up, and the relative strength is also starting to turn up, the momentum. So basically what I'm saying here is that when we get to this point in the cycle, what we should expect to see is early cycle leaders not doing so well, not so much in an absolute sense because the stock market is going up, but in a relative sense, where they were overperformers and now they're underperformers compared to mining stocks and resource stocks and basic industries and so forth, which were experiencing a declining trend of relative action, are now beginning to emerge on the upside. So this is kind of typically what we would do at this stage in the cycle, is examine all of these groups to make sure that they're doing what they're expected to do at that point in the cycle. It's what we call trust but verify. And if it's not acting in the way it should be, maybe the odd group isn't acting in the way it should be, then you ignore it and then expose yourself to the sectors which are performing and should be performing better at that stage in the cycle. So here's a great example of that, silver. So now we're looking at the S&P composite here, and the red highlights represent recessions and the beige highlights represent slowdowns. And underneath is the 18-month rate of change of the CRB spot raw industrials, industrial commodity prices. And what I've done here is to put in some vertical lines that kind of basically approximate to the low, using the benefit of hindsight, of course, approximate to the lows of the CRB, our 18-month rate of change. So the idea is when the rate of change bottoms out, that indicates that commodity prices are moving higher. And if commodity prices are moving higher, that should mean that the economy is in a better state of growth. And if you look at most of these situations here, like this one here, the commodities bottom out just as the slowdown is getting to an end. Or they bottom out here just as the recession is getting to an end. But I got a red line there because this was not followed, the improving economy was not followed by an improving stock market. It's one of the few times when that's happened in the past. And the reason was because the S&P was highly weighted to tech stocks and they were unwinding the tech bubble at the same time. So then we move over to here. There's a low in the rate of change and just towards the end of the financial crisis. And then these other two slowdowns have taken place right on cue when the rate of change of commodity prices started to bottom out. So you were towards the end of the slowdown. Not precise timing in this case here. I guess it was about 3 months out. But basically, when that rate of change of commodity prices starts to turn around, like it looks like it is doing now, that should indicate the end of the slowdown. So if we're at this point here, looking for a low in commodity prices, let's take a look at a couple of indicators that might be helpful in identifying commodity prices. Then we'll go onto the StockCharts platform and actually see what's going on in the marketplace. So this chart here compares the CRB spot raw industrials to a derivative of a leading indicator put out by the OECD. And the idea is that when this indicator crosses above zero, that's when we get one of these vertical lines. The green lines represent valid signals. In other words, it crosses zero, we get a nice rally in commodity prices. And the dashed lines, and there aren't very many of them, there's only 2 of them, indicate the failure. So here we cross zero, and that should have triggered a commodity rally, and it didn't. So that was a failed signal. And like with all this stuff, we find that a lot of these indicators work consistently about 80 or 90% of the time, but then nothing ever works perfectly 100% of the time. So anyway, we come to the current situation, in the current cycle, I should say. I should have put a green line in there. That wasn't followed by much of a rally, but it was followed by a stabilization in prices for a couple of years. The last one in 2016 was followed by a better rally. And we don't yet have a signal yet because the indicator is turned up, but it hasn't quite gone through the zero levels. That's why I say not all of the evidence is yet in that we are seeing a bottom in commodity prices. But one interesting thing is at the end of last month, the commodity price, which we take as the last Friday in the month, was just a little bit below, right at its 9-month moving average. This week it's up a little bit more. It's up to 453. It's not the end of the month yet because we've got to wait for the last Friday in January. But it shows you that commodity prices are on the cusp of turning up, at least industrial commodity prices are. So the other thing I wanted to show you was the fact that commodity prices are driven by the economy, and the economy is basically driven by psychology. And one of the ways in which you can figure out what the psychology is to take is to look at the momentum of credit spreads, where you take a good quality yield like a 20-year government and compare that to a lower quality yield, the Moody's corporate BAA yield. And then you take the ratio and then you create a long-term KST from the ratio, which is what we have here. So the idea is that when it's rising, it means people are getting more confident about the economy because they're less scared about defaults. So they're willing to go for the lower quality BAA bonds and shun the safety and lower yields of the government. So rising indicates confidence. And if people are confident about the economy, then that should mean that commodity prices are on the run on the upside. So let's take a look and put some arrows in here that show you when this indicator bottoms out. And consistently all the way through, you see what happens afterwards is that commodity prices rally. You never know how much they're going to rally or how long it's going to last. But as long as the rate of confidence continues to be improving, that's positive for commodities. So now what we see is the indicator is starting to turn up. So I put another arrow in there to suggest that this particular technique is suggesting that commodity prices are headed higher. I'd like to see it move up a little bit more than that. to be sure we got a turn. But if you look at most of these situations in the past, when we get a turn, it means what it says. The other thing I put in here is this black line here, which you can follow on StockCharts because it compares the long-term KST of the iBox high-yield corporate ETF, the HYG, to the iShares 7 to 10-year government trust, which is the IEF. And this is the same measure of that of those two bond market ETFs. And you can see it's not exact when they reverse pretty well at the same time there, pretty well at the same time here. There's a bit of a lag here. But generally speaking, what I like to see is both them turning up or turning down to be confident about the direction. And that's what we're seeing here. They're both turning up. So that's consistent. So you can follow this on StockCharts using underscore HYG divided by underscore IEF. You want to take the underscore, put the underscore in there so you don't include the dividends, which would give the, or interest, which would give the HYG an advantage. So I'm going to wrap up by looking at, before I get onto the StockCharts platform, on our schematic diagram where we look and see what, excuse me, what is happening with the momentum of the various sectors. So what we do is we take this as a long-term KST, a theoretical long-term KST, and this is its growth path. In other words, we have a position here which we call fall, which when it's above zero and falling, and then winter is the worst time of the coldest part of the year, and it's also the coldest technical part of the technical cycle. And winter occurs where the curve is below zero and falling. And then spring will be the next stage when it's below zero and rising. And then summer is again when it's above zero and rising. And what we see is that if we're going to get a market peak, we have a concentration of our sectors, and the S&P itself is going to be over here. And for a market bottom, we're going to see a concentration of sectors at in below zero, either falling or rising. That's where the KST will be. So let's take a look and see where we are in a current situation. So here's our theoretical KST diagram, and that's where bonds are right now, towards the high end of the curve. Stocks are at also in the summer position, and industrial commodities are still in the winter position, but very close to a turn, I believe, as you can see from some of those other charts. So what I'm going to do is to put up some early leaders and late cycle leaders. The early cycle leaders, things like REITs and utilities and consumer staples, will have a red arrow, and the late cycle leaders, the resource-based and so forth, will have a green arrow. So here's the early cycle just going up now, and you can see that they are very much concentrated in that summer markup period. Just about everything is in that period except for retail, which is down towards the low end of that curve, but still in a positive mode. And now we put the late cycle leaders in, and we get the same sort of thing. They're concentrated in the summer period, and a few laggards, as you would expect, coming up in the rear, down in the lower part of the curve. Now, that to me is pretty bullish. Obviously, I mentioned before that when we're looking at a bear market level, we'd expect everything to be down here like it was in 2003. But remember, we haven't come through a recession as we had in 2003. We've come through a slowdown. So what happened with a lot of stuff is it moved from this area of the cycle, it was coming down in the fall, and translated to, and then started to turn up and got into this position here. So that's not as good as when everything is down here because everything is washed out, but it's still positive because everything's in the markup phase. What we don't know is how long they're going to be going up through here. Will they start to turn down shortly, or will they expand for another 6 months, 9 months, or so forth? That's something we don't know. But what I can show you is what happened in 2007 at the market peak, and it doesn't look anything like this. This is where everything was in 2007. So let's just put it all up here quickly. It was all concentrated in the fall position. So either stuff was in the advanced fall, just about headed for winter, or it was in the topping out phase up here, or the topping out phase up there. So it's very, very dissimilar to where we are today, which I'll just go back to and show you again. So now I'd like to move over to the StockCharts platform. And I would like to talk about a little bit about the yield curve, maybe when we're through, because Greg and I were talking a little bit about the yield curve before we got on today. We had some ideas we wanted to share with you. So let's see where we go from there. So right now I'm going to get up with the StockCharts platform. Here's the world stock index and my global AD line. And as you can see, everything's in gear on the upside. Look, to me, it's very difficult to fault a chart like that. Obviously, it's very overstretched, but there's certainly no signs of any negative divergences or what have you. Next chart shows, when I say I think the bull market's in its early phase, this is one of the indicators that helps me come to that conclusion. This is the XLF, financial services sector, Spider Financials. And the first chart here is the S&P up on the top, the first plot. And the second down here is the long-term KST of the relative strength of financials. In other words, when this line is rising, it means that financials are outperforming the S&P on a momentum basis. And the idea is that when it's rising, we get one of these green shaded areas when it's above its moving average. And you can see what happens when we get a green shaded area when the relative strength of financials, the momentum, is in a positive trend. That's when we get our best stock market rallies. If we're going to run into trouble, like we did here in 2007, 2008, or 2008, 2009, I should say, that's when the curve is coming down. Then we see another one there, another one's 2015, 2016, and of course, in 2018, we had some weakness there going into December, and that all occurred when this indicator was in a downward trajectory. Well, right now, it's just started to go to a bullish trajectory. And that's why I say a lot of indicators I follow are actually doing a similar thing where they're either reversing from just a little bit above zero or reversing from below zero. And you saw before how that rate of change, and I should have mentioned it, the rate of change of commodity prices, which was bottoming out. When that bottoms out, typically you're going to get a rally in the stock market. And I forgot to mention that point. Maybe we can go back to that later and take a look at it. So here's another, here's what I call a confidence ratio, where we compare the S&P composite in the top to a ratio between technology and staples. When this ratio is rising, it means people are favoring technology, which are more speculative in nature than the very defensive staples. So that's when we get these green shaded areas, which I put in with the benefit of hindsight. So there's a low, there's a high, and there's a green shading between them. And you can see when we get the green shadings, that tends to be when you're getting a rally period. If you're going to have a weak period, as you had over here, that tends to be when the ratio is coming down. So right now, it was consolidating for a while between 2018 and early 2019. It broke out to the upside, and it just keeps moving higher and higher. And that's enabling it, obviously, to earn a green highlight and suggests that that's a pretty bullish backdrop for the equity market, even though everything is so very overstretched at this point. Now looking at inter-asset relationship stocks against, stocks against bonds. And you can see it's broken this downtrend line here, favoring stocks. It's crossed above its 200-day moving average. And a special K, which has a habit of peaking and troughing with the index, it's following. So here's the peak, and there's a trough just there, and there's another peak. You see the special K peaks and troughs with the actual series about 70% of the time. And there's the low, and there's the low. So it looks to me as if this relationship has now begun a new bull market. I'll be a bit more confident on that if it crosses the above this red line, the signal line here, which is a 100-day moving average of the 100-day moving average. But it does look as if stocks are going to outperform bonds here, which typically happens during this stage of the cycle. So that's a kind of a check mark that says, yeah, you're right in terms of looking for a potential low in commodity prices here. Look at a couple of foreign markets that I think are kind of interesting. This is China, the Shanghai Composite, and here is the 2015 top. And you can see it join the trend, join this peak here, and right now it's just right at that trend line. Very, very significant. It looks to me like it's going to go through because the short-term KST is bullish. The intermediate is just starting to go through it. If it does break above that trend line, I think you'll see all hell break loose on the upside in the Chinese market. Already the long-term KST has started to turn around. Here's the same market, but this time we're looking at a shorter period, and it looks like it's forming an inverse head and shoulders. Now, we don't have the 31st of December in here, but it went up a little bit, actually went slightly above that line on the 31st of December, but it hasn't. As we're doing this, the StockCharts hasn't updated yet, so it won't go to the end of the day. But it does look like it's going to complete this reverse head and shoulders. And I have an intermediate diffusion indicator I use for the Chinese market as well, where I look at a number of stocks above their 50-week moving average. And that's been very, very reliable, and that went bullish last week. So I'm quite optimistic about the Chinese market here. It's been lagging, and I think it's going to probably start to do better. And here's another reason why I think we may get a very sharp move up in the market. Here's the Shanghai Composite. Here's the downtrend line going back to 2015. It's been broken. It was broken on the 30th of December, and the market went up a little bit more, as I said, on the 31st. So it's more of a decisive breakout. But the thing which impresses me is the fact that this long-term downtrend line going back, 12 years, 11 or 12 years, has been broken on the upside. Not dissimilar to this situation back here in 2006. And you can see what followed that. I'm not predicting anything like that, but I do think the market will be I do think it's going to be pretty strong going into this year. And maybe, Greg, later on we could look at a couple of Chinese ETFs to kind of bear this out. So next, the other market I was interested in, I think looks interesting from a potential breakout point of view, is the EWW, which is the MSCI Mexico ETF. And it's been in a downtrend here from 2015 and is now above its 12-month moving average and just a little bit below the trend line. If it breaks that trend line at 46, I think it's all systems go for Mexico. And one of the reasons I think that's the case is the long-term KST here, which measures primary trends, has just started to turn up. Here we're looking again at the EWW, and you can see this downtrend here. This is on a weekly basis, sorry, a daily basis. And you can see this trend line much more clearly, and you can see that we saw on the monthly chart, and it wouldn't take much to push through on the upside. As I mentioned before, the long-term KST is bullish here, but here's the relative action against the S&P. Remember, this is an ETF, so it's expressed in dollars, so it's a legitimate comparison. And you can see that the RS line is still in its downtrend and right at its 200-day moving average here. So just below very important support. Obviously, this stuff hasn't broken to the upside yet, but the momentum is suggesting that it probably will. And here you see the relative strength and momentum for the Mexico firm. And that again looks like it's just prime ready to go bullish here. So I think it's something worth watching out. Now we'll take a look at bond prices, or bond yields, I should say. Here's the TNX, the 10-year, displaying from 1983, the secular or very long-term downtrend line, the downtrend. And it looks like what happens when all secular trends get reversed, this is a secular downtrend, you get some distribution that occurs, or in this case, accumulation. Up here it was distribution with this huge head and shoulders top. Down here it's this kind of more of this kind of rectangle approach down here. Obviously, you don't get a signal until it crosses above the thick green line here, and it also breaks it. That would enable it to break above its 96-month moving average and this green downtrend line here. But one of the things But I expect that will happen eventually. But all I'm confident about right now is that bond yields are going to rally, because this indicator on the bottom panel, which is a 12-month rate of change, when it bottoms from an extreme level, that's when we get, and reverses up, that's when we get one of these arrows. And each of these arrows was pretty effective. Remember, this is a downtrend, so the dominant forces were on the negative side, and yet still, when we got down to these extreme levels, we got a nice rally in bond yields. And in this case here, we've just seen another reversal take place, and I would expect it to be a much more significant than this bounce that's already taken place. Now, it may not go straight up, it may go wishy-washy like it did here. One never knows, but I think when you get to one of these extremes, it does suggest that you're seeing a basic reversal. Also, if we're correct about the commodity markets in the process of reversing, then obviously the worst enemy for bond yields is rising commodity prices. So that could be a problem. Let's have a look at the next panel here. And here we have the TYX this time. And again, what we're showing is a series of lower bottoms. Remember the TNX, the 10-year, it was a kind of a horizontal bottom. With the TYX, the 30-year, it's declining bottoms. But each time it comes down to this extended trend line, it seems to find support. Intermediate KST is not even above zero yet. So again, this is another reason why I'm expecting to see higher bond yields take place, or certainly some upward pressure here. One of my favorite indicators is the commodity bond ratio. That's what we have here. And this one has broken above this trend line. It's broken above its 200-day moving average, suggesting it's going to rally. When it rallies, that means that commodities outperform bonds, because this is a CRB composite against the 7 to 10-year iShares 7 to 10-year ETF. And that's adjusted to exclude dividends and interest. So the other thing that makes me positive here is the KST, which again, if you look at this chart, as I mentioned before, about 70% of the time, peaks in the KST and troughs in a special K, I should say, correspond to turning points in the actual price. So what we have to do is figure out when a thing is reversed, and that's done basically with the signal line crossovers and with trend line breaks. And you can see we got a good buy signal there, good sell signal here. A smaller trend in this case here, but definitely a trend breaking reversing signal, suggesting that commodities are going to outperform bonds for the foreseeable future. So now we are looking at the CRB composite itself, and it peaked in 2008. And I've drawn a line in here which excludes this false breakout here in 2014. And I'm sure a lot of people would prefer to see a line that would touch the top of that and go down, and that would, of course, have yet been violated. But I try and figure out which line is the one that reflects the underlying trend best. And in this case here, if we touch this point here, and we touch that point, we could also touch that point. So it's been touched 1, 2, 3, 4 times. Whereas if we touch this one, it's only been touched once. So I think this is a better reflection of the underlying trend. And that has now been broken on the upside. So that to me is very positive for the CRB composite, because it was also looked like it was forming a kind of a head and shoulders here, and it failed to form that head and shoulders. When it tries to form a head and shoulders and fails, it means a lot of people are kind of getting bearish along here. And when it breaks to the upside, they've got to kind of unwind their positions or reposition themselves. That's why we tend to get an above average move from a whipsaw move or a false head and shoulders top move. But notice also that the Kopach curve has given us a buy signal, and each of these solid green lines show you valid buy signals. That was a great buy signal. There was a buy signal. There was a great buy signal. The dashed lines represent the failures. So there's 2 failures, 3 failures that have taken place in a period of 30, 40, 50 years. So I'm willing to go with that one there, because there's been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 valid buy signals. I should say 12 because I counted that one there. So there have been 12 valid buy signals. I think that one's going to turn into a valid one too. So sometimes I look around for corroborating evidence when I see bottoms in markets or turning points in markets. So here's a CRB composite up in the top here. Here's another trend line break here that took place. And what we find is the Canadian dollar and the CRB composite move very closely together on a kind of not on a day-by-day basis, but on a trend-by-trend basis. So, for example, here's the KST for the Canadian dollar with these green arrows, and that shows the buy signals. Each time you get an arrow, a buy signal for Canadian dollar, it's a good time to be buying commodities. And we just got another buy signal. It's just very, very marginal at this point. I expect it to turn into a decisive signal because look what the Canadian dollar has done on a monthly basis. It's broken this long-term trend line going all the way back to 2012, 2013. So that breaking of that line and the crossing of the 12-month moving average suggests to me that the Canadian dollar has stopped going down. And if it stopped going down, this KST is going to start to turn up. So more likely what's happening with the Canadian dollar is it's going to go up, not stop going down. It's actually going to reverse and go to the upside. And that is completely consistent with what's happening with the CRB composite. We can play the same little game with the Aussie dollar as well. Once again, the KST buy signals are represented by the arrow. And every time we get a buy signal, except this one here on the Aussie dollar, it's paid to buy commodity prices, to buy commodities. So here we're seeing the Aussie dollar just right at its, you can't even see its 12-month moving average because it's underneath the trend line. On a weekly chart, this is broken out, but it hasn't yet quite broken out in the monthly chart, and that is up to the 31st of December. So we have to wait till next year to find out. Well, it seems to me that very likely we'll get a buy signal here, and the KST will go positive as well. So let's move on a little bit here. And I've just been advised that my internet service is not working properly. So that's why we're getting these technical glitches here. So here again is the CRB composite. As you can see, it's broken above this downtrend line like it had before. Here's the head and shoulders I was pointing out to you. And here is the Pring inflation deflation ratio. This is a ratio of inflation-sensitive stocks, exclamation mark PRII, and compared to the exclamation mark PRDI, Pring deflation index, and Pring inflation index. So that's how you calculate this. But the point is, here's the secular downtrend line going back to 2012, and the ratio, as at the 30th of the month, hasn't dated yet, has broken pretty well decisively of this trend line. And the KST just given a marginal buy signals. Again, the thing is falling into place for a multiple set of signals on the commodity markets next month, because this month we've already had some signals like this one on the CRB composite. So I'm going to move on a little bit here and just compare the CRB composite this time to one of those confidence yields that we looked at before, the iBox HYG against the IEF. So when it's rising, it means people are getting more confident because they're going into high yield junk bonds rather than governments. And when it's coming down, they're losing confidence and they go for the safety of the governments, and the governments outperform high yield. And as you can see with these arrows, they're just meant to sort of basically indicate that confidence in the bond market is reflected in a trend of higher commodity prices, or a lack of confidence in a trend of declining commodity prices. So that's what all these arrows are there to represent. And as you can see, we saw a breakout in a CRB composite earlier this late this year, I should say. And we see the same thing with the confidence ratio. It also experienced a whipsaw down here. And that whipsaw, we know it's a whipsaw now because it's moved back above the red line and it's broken above the green dash line. So there is an indication of a voting confidence, a new trend taking place. And if there's a new trend of growing confidence, that's got to spill over, or most likely will spill over into the commodity market. That's just a chart of the CRB on a weekly basis. Here's the breakout, and you can see the short-term KST has started to turn up, and the intermediate KST has only just begun to get going here. So again, with that short intermediate momentum going into next year, which the first quarter is usually pretty bullish seasonally for commodity prices. So that's going in at the right time of the year, and it also looks from our economic work as if we're getting out of that slowdown period. So now we look at the US dollar. I mentioned before that the US dollar started to break down. Here's this trend line going back to early part of 2018. Here's the 200-day moving average. It's broken below both. The special K is still above its red trend line, but just a little bit of weakness in the dollar suggests to me that the special K will actually continue to weaken. One of the ways in which you can figure out the market's oversold is look at this one here, the KST, and it's not yet oversold. So that suggests further downside possibilities. And then we move to the final panel. And here is the Wisdom Tree Bloomberg US dollar bullish fund. This is a much more broadly based fund than the dollar index, which has a 57% weighting in the euro. So it's a very broadly based indicator, and it's actually a lot weaker in the last few days. It's been a lot weaker than the dollar index itself. So it's kind of indicating a broad decline that's taking place in the dollar. Also, we see the short term is bearish, the intermediate is bearish, and the long term KST is kind of neutral. So it would suggest downward pressure from these, and the downside breakout will actually result in a long-term sell signal before long. So I think I'm going to wrap it up there, Greg. I'm going to put up an oil chart because I know you like oil. I don't get a lot out of this chart in terms of trends and trend lines, but I do notice that the copper curve has started to turn up, and that should make you guys in Calgary pretty happy.
Yeah, it definitely does, Martin. We have probably one of the biggest things going on in oil, I think, is the decline in the growth of the Permian in the U.S. And some really interesting statistics came out just recently here where the rate of the decline rates of a well. So when you drill a well, it starts off very frothy and you get lots of production. And then as the well runs on for a year or two, the production declines. Well, the problem is that they've drilled a lot of the tier 1 properties, so all the good rock, and now they're kind of working on tier 2 properties. And so the issue that we're starting to see is the decline rates are much faster and the initial production surges aren't as good as they were. So we're actually, we're drilling less wells now, and the wells we're drilling have both less long-term production and less short-term production with a more rapid decline rate. So there's a lot of tension coming into the oil market here with, if we're going to see this economic expansion, which, globally everything is going up, it does make us wonder where we're going to get the oil from. And so that's the first one. The second component of that is that we really haven't built a lot of mega projects over the last 10 years, really since 2014. No new ones have been planned. And while on the oil chart, we can see that 2008 spike. Then in 2011, we had a spike and a pullback. Then 2014, we had a spike and a pullback. And all of this, kept getting management to make fewer and fewer long-term major economic decisions. An example would be the new LNG terminal for Western Canada. So it'll take oil out of kind of the 60th latitude, somewhere up around there, and take it over to the West Coast and then take that to China. That project is $20 billion. So when you're a CEO and you got to sign off on these $20 billion projects, it really is hard when you keep seeing, lower highs on this oil chart. So the 08, the 11, the 14, the 18, very difficult to sign off on these major projects. And so with all of that, we're having a lot less drilling, a lot less big projects, but we still see a continuing rise in demand slowly, albeit, but a continuing rise in demand. So it's going to be pretty interesting to see how this all shakes out.
So basically, you're saying the copper curve is right.
I think the copper curve is really right. The one, there's a stock in Canada called CNQ, ticker symbol on both sides of the border, and it is absolutely, it's already hit 52-week highs in an oil stock, where the XOP is at 20-year.
N as in Nancy or M as in Melbourne.
Oh, so it's Charlie Nancy Quebec, yeah.
Quebec.
Yeah, Q, yeah. And this stock's already, out at 52-week highs, and if you put it up on a 5-year, it's really a beautiful chart.
Oh, potentially.
Yeah, so this is just starting to break out now. They bought so many assets from Shell and Devon Energy or whatever in 2014 and 15. I think they were 600,000 barrels a day. Now they're 1.3 million barrels a day. So the free cash flow that they can spin off now is absolutely massive. So I'm very interested to see how this chart works, because again, XOP, the exploration and production ETF, is at 13-year lows, and the oil services index is at 20-year lows. So your KST is just starting to turn up here. This looks exciting to me. I think it's one of those charts that could go to the moon. Now, I own it, but their free cash flow is just stunning. And if we get any sort of rise in the price of oil, we'll see a chart like this just explode higher. When I look at ConocoPhillips or Chevron, those charts, they're also pretty good. So CVX, Charlie Victor X-ray.
Just like CVX.
Yeah. That chart doesn't look that broken to me. So even when you consider that we've had lower highs in oil, and this chart's up in the top right, and it looks like we've potentially got a KST ready to turn up here, that is a really nice situation. And COP is the other one.
See what?
COP, so Charlie, Oxford, and Papa, yeah. So that one's just starting to ramp up again. And again, on this chart, you see higher highs in the stock and lower highs on the price of oil. So this one looks like another one of those that could outperform. And if we start to get your KST turning up above zero, that's a very bullish place to get on board.
It would be.
Yeah, so I like the situation for oil here. I think we're just starting to see the impact of the Saudi oil attacks. So they had a lot of oil in inventory and were able to handle the shortage of immediate issues. Now we're starting to see their total oil delivery slow a little bit. But more importantly, I think, is that the rest of the world hasn't been building anything new out. So that's where we're getting more into an area of concern.
So, Greg, you and I earlier were talking about the 10-2 yield curve.
Mm-hmm.
You had a few problems.
Well, the one thing that I notice is if you draw trend lines on this, and I'm interested to see how yours is different than mine. Oh, yours is a logarithmic scale. That would be the reason. So on this yield curve, what I see, if you take the 1983 to 2000 trend line, when that broke, that was a pretty important indicator. You also see it in 1987 to 1990 when that trend line broke. That was a pretty good indicator. And you see it in the 2003 to 2008 when that trend line broke. That was another one, yeah, right up in there. So downsloping trend line off the highs. And now we've got that same thing going on over here in the, this one's been a little bit longer, kind of a 5-year trend line, but that one's starting to crack. So I'm not sure why, but yours doesn't show a new 52-week high yet, but mine on this one shows a new 52-week high. So starting to see that breakout to the upside. And I think it's not just the one chart, the 30-year minus the 3-month, and the 30 minus the 5 years, also an important one, the 30 minus the 10. They're all starting to kick off signals for me.
It doesn't show because it's not up to date. It's only up to the end of November, because when I put this chart together, I didn't have the end of the year data.
Right.
I couldn't put it in. And you probably got it on a weekly basis. That's how you...
Yeah, that's right. Yeah.
But when I look at this, it gets me kind of worried when I see the yield curve invert and then start to steepen again. That tends to be when you get a recession.
Yes.
But if you uncover, but what you're trying to do is use the yield curve to forecast the economy as opposed to the yield curve. So if you put an economic indicator in, this one here is a momentum indicator from our Pring leading economic indicator, which has led every recession since the 50s. And the red vertical lines represent the start of a recession. That this one here could move over a little bit. I can't change it.
Yeah, close enough. Yeah.
But you can see what happens when we get the recession is the indicator is down towards the triggering line, recession triggering line on each of these occasions. And right now it's actually moving up, not going down.
Yeah, and I don't get me wrong. I think one of the things, and I agree with your chart. And the one thing, it's hard to have a market top when things aren't going up before it. So, everything kind of rises up. But here we're making, on your recession indicator, we're making lower highs and lower lows. And so far, I'll call it in the short term, the last year, we've been turning up for the year, and I still think that's a positive. I'm just starting to notice that on this yield curve, the spreads, when it really starts to accelerate vertically, that's more important to be aware of. And again, we just started to break out to new 52-week highs on that chart now. And I'm going to go through all the other spreads and kind of put together a little video about it. Again, you still have to use price on the S&P as a good reminder of what's going on. But I want to be aware of some of these other signals that are starting to fire off. And that's one of the ones that's starting to make me think a little bit harder.
I think you're absolutely right. And of course, one of the reasons why it begins to move away from the inversion, it gets steeper, is because the economy is getting weaker. So when it's doing that, it's reflecting a weak economy. And at some point, economy goes negative, and that's why you get one of the red highlights for a recession.
Yeah.
You're absolutely right. All I'm saying is that I like to use the two in combination. Now, if this indicator here was down, continued this downward trajectory, and it was just around the zero line, then I begin to get a little worried. But since it's rallying up, indicating we're coming out of the slowdown, I can rationalize what would otherwise be a bearish yield curve action.
Yeah. And again, I still think it's, for me, everything is still trending higher. So I don't want to start calling a recession anytime soon. The one thing that this chart is starting to say is at least be aware of the potential for something. So if all of a sudden we started to see whatever industrial production slow down or housing slow down or something like that, that we should be more attuned to that.
Yeah, well, fortunately, all that stuff's pointing north at the present time.
Yeah, I agree. It all looks very, very strong.
But when you look at some of these, they say it's a strong economy. It's actually an economy operating at a high level. The growth path, as you can see from a lot of these indicators, is not that strong, and it's starting to get better. But what it means, seems to me that if we're in a kind of a trading range for a lot of these indicators, like that ECRI, we're breaking out of it. But if we get some unexpected bad news that affects the economy, then that could change everything, because it's very, very finely balanced, but coming out of the coming up instead of going down below zero at this point.
Yeah, I agree. And again, everything's still pointing up. So now I'm just starting to look for things that might be clues, but so far everything I've got is bullish. Hey, Martin, we should probably wrap this up as we're running out of time, but thank you again. And thank you for doing this all year and every year. It's been really, really nice. Very important charts in there. Thanks again.
Thanks, Craig.